Hi, guys, and good evening. Welcome to this webinar that we're hosting. And as we navigate through a world of increasingly defined by environmental change, socio-economic shifts, sustainable finance has emerged as a powerful catalyst for this change. And India, with its ambitious sustainability goals, stands at a critical juncture where integrating sustainability principles into finance decision making is no longer an option, but it's an imperative. My name is Karunya Rao, and today I'll be the host for this session. The global green market, the global green finance market, is poised for significant growth, projected to soar about $7,947.3 billion by 2032, with Asia Pacific emerging as the largest and the fastest growing region. The growth underscores the urgency and relevance of adopting green financial practices to drive economic and sustainable resilience. Today, this webinar is going to be all about exploring sustainable investment opportunities. We will be delving here into how sustainable investing strategies have evolved from more compliance measures to critical business drivers. Now, these strategies are essential for enhancing competitiveness, fostering stakeholder trust, and generating long term financial returns. So let's get started and welcome in our speakers on this show. We have an esteemed panel of experts for an insightful decision today on India's journey in sustainable finance. First up, joining us is Ms. Sonia Gandhi, CFA, Senior Director, Education at CFA Institute. A seasoned investment professional with a deep commitment to advancing excellence in financial education. Sonia plays a pivotal role in shaping the future of sustainable finance education. She leads initiatives to equip finance professionals with critical knowledge of sustainable business models, carbon pricing, integration of climate risk into investment analysis, and of course, portfolio construction. Sonia, hi, and welcome on board.
Thank you.
Moving on to our next speaker for the day, Mr. Hardik Shah, CFA, Head of Sustainable Investment at DSP Asset Managers. Now, as a CFA professional with over 16 years of expertise in ESG research and investing, Hardik is a leading voice in sustainable investment practices. He has led global ESG initiatives, including proprietary scoring models and carbon credit advisory, driving impactful sustainable investment solutions across the board. Hardik, hi, great to have you with us today.
Thank you for having me.
And our third speaker for the day, Mr. Ankur Gupta, CFA, Vice President, Sustainable Investments, North Trust Asset Management. With 16 years of expertise in product management, research, sustainable investing, etc., Ankur brings valuable insights on the integration of sustainability in financial strategies. Now, he has led several initiatives like net zero solutions and TCFD reporting while advocating for ESG policy advancements. So, without any ado, let's explore the growing importance of green investment and its pivotal role in driving long term economic growth as well as sustainability in India. Sonia, Ankur, Hardik, let's get started. My first question will be to Sonia. Hi. Let's just set the context, set the tone right before we delve deeper into it. Just if you could explain sustainable finance, what it encompasses, and more importantly, why is it essential for India's long term economic or even environmental sustainability? Hardik, if you could get us
Sure.
started on that.
I can chime in for sure.
Yeah.
Yeah. So I think when you think about sustainable finance, it's essentially taking certain financing decisions or investment decisions while considering what is broadly known as ESG or environmental, social, and governance factors. This essentially means is when you are making those decisions, you want to take into account the good or the bad impacts on the environment or the society of those decisions and not just the financial impact, right? This could be in different forms, in different asset classes. It could be equities, it could be bonds, it could be even sustainable loans or green loans as we know it. Intention eventually is to have I think in more often than not support an economic activity that is having a positive impact on the environment or the society. Now, to your question around why is it important for India, right? So you might say, okay, these are all first world shenanigans, right? Why should we in emerging markets be kind of worried about this? The reason is, and I'll take an example of climate change while trying to explain that. Global warming and the related kind of change in climate is something that you and I are facing in our day-to-day lives. I remember when I started off in this space 15 years back, climate change was thought to be something that is for the next generation. Maybe we need to do something to prevent bad effects on the environment and the society in the next generation. It's actually already playing out in our own lifetimes. Now, what has happened in the last 50, 60 years, especially, is because of the growth of industrialization broadly, carbon emissions in the world have basically quadrupled, right? And there is no sign that they are slowing down. In parallel, there is another temperature measure that most people track is around, okay, how much warmer are we today versus the pre-industrial levels. The Paris Climate Agreement had a target of limiting global warming below 2 degrees Celsius, preferably around 1.5. This
Hmm.
year alone, in 2024, you are clearly seeing, I would say, almost every single month being 1.5 degree or so higher than before. So the ill effects of these changing weather patterns and, more importantly, long-term change in climate is playing out in our day-to-day lives, whether you're talking about floods or storms, wildfires, droughts, and so on and so forth. So this is not necessarily something that we want to do to protect the environment or the world we live in. Is actually to protect our day-to-day lives, and keep it as normal as possible. And hence, I think even in a country like India, we should be concerned about the kind of ESG issues, and while we make those financing and investing decisions.
Sonia, you have been deeply committed to financial education. Have you ever faced any concerns or any questions about why now and why does India have to focus or press the pedal on environmental sustainability? When clearly it's a very very nascent and small sort of part of the entire ecosystem right now. But how important is it going forward and for the future?
Well, sustainability is it's such a rapidly evolving space, and I think everybody, for us to make any inroads in this space, everybody has to be involved. And we are at the forefront of it, and we are seeing that education is playing an extremely important role. I feel education and awareness around this important topic are likely to be the game changers. People need to understand what's driving these changes to our ecosystem, our planet, what can be done to address or navigate these challenges, and the role that they can play in addressing these issues. And so and more importantly, finance can play such an important role. You talked about specifically India. I would say globally it plays a very important role, whether you are looking at the issuers, whether you are looking at investors,
Hmm.
the choices that companies are making and how they are thinking about transitioning to net zero, how they are financing this, or whether you are a capital allocator, how they think about directing capital. So
Hmm.
it's very important.
Well, let's also, talk business now. Hardik, let's talk about instruments, whether it's green bonds, sustainability linked financial products. How do they really impact or rather shape up the investment landscape in India right now as we speak? And what considerations do or should fund managers and corporates keep in mind while evaluating sustainable investment across avenues?
Sure. So I think the Indian market has been kind of, I would say, exposed to a wide variety of instruments. So let's maybe focus on green bonds, or more broadly, sustainability linked bonds first. Now these are essentially instruments that are trying to raise capital to finance green and or sustainable projects. The intention here is essentially to kind of use these proceeds that are raised, typically by a financial institution, but or oftentimes even corporates come up with their own kind of green bond issuances. But their objective here is to kind of finance a project which is kind of, let's say, for example, putting up a solar or a renewable energy power plant to meet your electricity needs. It could be maybe implementing a water recycling project within your facility to kind of be a little bit more water efficient, and so on and so forth. These instruments essentially are used to direct capital in the right direction, which is towards environmental friendly projects. Now, from a fund manager's perspective, what kind of criteria should you be concerned about while you invest in these? I think, to me, to my kind of best of my knowledge, there are two areas we should focus on. The first
Hmm.
being, is the project or the activity actually green, right? There is a whole lot of, I would say, activities that are being repackaged as green just to kind of access this pool of capital, and hence you want to make sure, is this actually green? Is it going to cause any incremental positive impact or avoid any incremental negative impact to the environment, to the society? And then the other factor is, this should not be done only at the point of issuance. So when the corporate, for example, is trying to raise money, yes, of course, you should do the due diligence before investing, but more
Hmm.
importantly, there has to be processes in place to do this on a more periodic basis, because once the funds are raised, are the use of proceeds going in the right direction in the right projects that they initially committed to? So I think these are some of the things investors should keep in mind. So that's kind of on the green bond side. If you may give me a couple of minutes, I'll also kind of talk more about broad impact investing, and that's another
Sure.
area that's picking up. I would say today in the Indian market, this is much more prominent in the private equity and VC space rather than in the public equity space. But essentially, what impact investing seeks is to basically generate measurable social or environmental impacts, positive impacts, while also alongside trying to generate returns. So this is not charity, this is not just philanthropy. You're trying to generate returns, but also cause a positive impact on the environment or the society while doing so. Examples here could mean affordable housing kind of investments. It could be climate solutions. So we talked about earlier renewable energy as an example. It could be education. That's the topic that you want to, in a way, focus more on, or affordable healthcare and so on and so forth. Here, I think when you look at it from an investor's perspective, I think there are a couple of key criteria that should be kind of kept in mind. In a way, is when you talk about impact, it gets a little tricky, because impact could mean very different things to different people. So there has to be very clearly defined KPIs or metrics upfront, saying, okay, here are the two or three things that this investment or this fund is trying to achieve and improve, and this is how we will measure it, and this is how we will kind of report it to all stakeholders. So I think this is pretty important, because if you take an example, microfinance is a big theme in India, right? So if you are raising funds, or if you're investing in a, let's say, a bank who's, or a microfinance institution who's trying to increase their outreach. So let's say now going from tier 1 tier 2 cities to further down in the rural parts of India, maybe trying to get about 1 million people who are like currently underbanked or unbanked population into the banking kind of sector. That's a clear positive impact that you have, and you can measure it over time. So these are the type of examples I would say you need to keep in mind while evaluating such investments.
Interesting. Ankur, I want to rope you in as well. Do you see a significant rise in demand when it comes to sustainable investing across corporates, financial institutions, etc.? What is your assessment?
Yeah, sure. So, interestingly, started my journey into sustainable investing back in 2014, which is the time I would say SI was not considered as a mainstream topic or a criteria for investment, to the time we have reached where it has become completely mainstream. Uh, so to just throw some numbers to give you a sense how sustainable investing assets have been growing from 2016 to 2022, there was a CAGR of 32% increase in terms of AUM for SI assets, where it has reached to close to about 30 trillion of USD in terms of the overall growth. A recent research from Bloomberg also tells that from 2024 to 2030, SI assets will see a growth of 18% every year, making it to reach close to about 80 trillion by 2030. So these numbers, and obviously the way market is shaping up, is clearly in favor in terms of how sustainability impact and how this has been rising and becoming extremely important for corporates and as well as financial institutions. While you will notice that majority of this growth, people have that impression that EMEA is the core of all the SI assets. Just to break some myth, APEC has been really catching up in last few years, and most of the markets like Australia, New Zealand, and Japan have been growing at a CAGR of more than 30%. So I'm very hopeful that in next few years, APAC is going to be the mainstream market with a lot of SI growth, which we are seeing in coming in due years. Lastly, I would say we kind of start noticing a lot of the disclosures and the annual reports which corporates are publishing. Sustainability is one of the core pillar of their business strategy, which was not the case several years ago. So this clearly highlights the impact sustainability investing has created. And as companies try to understand and align their business strategy in alignment with their stakeholders, and as well as they understand the impact of these material ESG issues, it has become an increasing toll on these companies where they are disclosing this information for the betterment and also get a better sense how they align their business strategy to wider stakeholders and moving needs in the market.
Sonia, what do you think, in your view, how crucial are education and upskilling for building a sustainable finance ecosystem? And what, more importantly, are the primary skills, knowledge gaps which financial professionals are facing right now regarding sustainable finance? And how can that be addressed?
So let me respond to your question with an anecdote. Earlier this year, we launched our climate risk valuation and investing certificate. That's the only time I'll refer to it by its full name. I'll call it climate certificate. So last year, when we started planning for this offering, we organized roundtables with practitioners. And these are practitioners who worked in the industry for a very, very long time. They are doing investment analysis and be it as a research analyst, as a portfolio manager in various capacities. And we posed this question to them. We said, we are looking to develop an educational offering in climate to help people upskill people like you. What would you like us to incorporate? What are the skills you are struggling with? And something which was a bit surprising to us, and we heard it loud and clear. Most of our members, they acknowledge that sustainability, climate-related risk and opportunities, these are material factors. These need to be incorporated in investment analysis and decision-making. But they said we can see the increased severity and frequency of hurricanes, we can see wildfires, floods, and these are having a meaningful impact on companies and the infrastructure in which we are invested. But we don't understand the science behind it. What's causing these changes to our planet? And they said, if we don't understand the science behind it, how are we going to convince our clients about thinking deeply about these issues? So we really took this feedback to heart. And in our climate certificate, we put climate science right at the top. We start with the concepts and science behind these changes. The other feedback we received through our market intelligence was, they said there are all these offerings, we learn a lot about theory of incorporating sustainability factors, and we understand the various methodologies and the various metrics. But when we go back to our day jobs, we don't know how to apply these concepts. Whether it's materiality, whether it's thinking about developing net zero aligned portfolios or integrating sustainability factors. So what we heard was there are tools, there are techniques, there are methodologies which are available, but there is very little application-based learning available out there. Even on the issuer side, they have to navigate the vast array of disclosure requirements. Then they have to think about their financing options. Should we think of green bonds? Should we think of sustainability-linked bonds? How should we set our net zero goals? How do we balance ambition with practicality? So these are the kind of skills that can make a meaningful difference to the robust development of a sustainable finance ecosystem. And these are the skills we are focusing to help practitioners develop.
Now, over and above upskilling, education, what are the other important considerations which could move the needle?
So when I think of capacity built in sustainable finance, there are three things that come to my mind. Education, which we already talked about, engagement, and sensible regulatory frameworks. What I mean is the move from voluntary to mandatory frameworks. So let's talk about these two. We've spoken about education. When we think about the regulation piece, we understand that companies play an important role in how the world is producing and consuming goods and services. So how companies disclose their disclosures are, they inform different stakeholders, how the activities of these organizations are influencing and are in turn being influenced by a changing climate. And we realize that this information is extremely important to capital allocators. It could be government, it could be public sector, private actors. Everyone needs this information to enable them to make optimal decisions, to ensure that they are allocating capital in a manner that supports effective and smooth transition to a low carbon economy. So the idea is that we need to create an environment where capital allocators have access to what we like to call comparable decision useful information. And we believe that this is where regulations can play a big role towards ensuring better disclosure, improved transparency, consistency, and comparability. And organizations like voluntary frameworks like TCFD, Task Force on Climate-Related Financial Disclosures, which is now part of the IFRS Foundation, they've been instrumental in this space. Companies are using their recommendations around climate-related disclosures. But also when you look at the FSP 2023 Annual Progress Report, we see that the percentage of companies which are disclosing TCFD-aligned information, it's growing, but more progress is needed. So what will the shift from voluntary to mandatory do? It will ensure full market participation. It will establish a level playing field. It will enhance transparency. There'll be consistency and comparability. It will improve quality of disclosed information. It will lead to enhanced public awareness and accountability, and it will ensure enhanced risk management. And the other thing, I think, which is also equally important piece, apart from education and sensible regulatory frameworks, is engagement. So at CFA Institute, we think about how finance industry exercises influence in three important ways. Asset owners allocate their capital to drive equitable outcomes. Secondly, they engage with companies to drive change. And lastly, they engage with policymakers to advocate for change. And as both my co-panelists will agree, decarbonizing portfolios by diverting high greenhouse gas emitters, shifting capital away from fossil fuels towards cleaner alternatives, it's not going to take care of the real world problem. It will merely make it somebody else's problem. So if we want to drive real world change, if we want to have a robust, sustainable finance infrastructure, engagement is a very, very sharp tool. And it's also a very important part of stewardship, right? Which is using investor rights and influence to protect and enhance overall long-term value for clients and beneficiaries. In fact, in certain jurisdictions, I sit in the UK, in London, asset owners are voluntarily bound by the UK Stewardship Code, which aims to engage active ownership and monitoring practices. So asset owners will need to prove to their board of trustees how they are engaging with companies on climate practices, and they will need to provide quantitative metrics showing improvements over time. So engagement, education, sensible regulatory frameworks, I think these three together can really move the needle in this space.
Great. And can you also tell us how certifications by CFA Institute, whether it's sustainable investing certification, support an understanding of sustainable investment practices in the financial sector? So if you could talk a bit about how have you devised or crafted these certifications here?
So at the Institute, and since we are a global body, we have 190,000 plus members working in the industry, we get a lot of useful insights. And we understand that people are at different stages in their sustainability journey. They are looking for different things. And we think deeply about how we can address the needs of diverse stakeholders. So we think of our sustainability offerings in terms of a suite of offerings, depending on where the practitioner is in their sustainability journey. So if you want to understand the basics of environmental, social governance factors, if you want to have meaningful conversations around these factors, you want to understand what the media is talking about, how do I understand it better? We have this certificate in ESG investing. It provides a well rounded understanding of these issues. But if you ask me, more importantly, what this certificate does is it provides you with a common vocabulary to be able to discuss and think about these issues. So that's one part of it. But as I mentioned earlier, our market research, our practitioner roundtables, we became cognizant of the fact that there is a significant gap in the market, a product that equips practitioners with application based skills. And so we deeply thought about what can we do? How can we help our members and other industry practitioners gain these skills? So we tried to incorporate this in the climate certificate, which was launched earlier this year. I worked with Hardik as well on that. We aim to provide practitioners not only with necessary tools and techniques, but practical skills on how to apply these skills. So, how did we do that? And we did things that we've never before done at the Institute because sustainability posed such a challenge for us. So, we introduced a cohort based learning model. Uh, Sustainability is such a rapidly evolving space. It lends itself beautifully to a cohort based learning model where learners are advancing through the material more or less at the same time. And so they are able to have meaningful conversations, discussions with each other. On discussion boards, they are learning from each other's lived experiences. And then, how do I test for these skills? And believe me when I say that testing for applications based skills is not an easy task. It's something we had never done before. So we introduced praxis assignments. So where you apply your learnings hands on in the safe environment of your peers. The objective being that it gives you the confidence. So then when you go back to your day job, you can apply that. For example, in course 2, we asked learners to analyze a company's transition plan. So we provided them 3 real transition plans of real companies. We gave them a robust rubric. How should they think about the company's short-term targets, long-term targets? Are they science-based? What are the financing options? And then they reviewed that. Their work got peer reviewed by 2 other learners. They peer reviewed the work of 2 other learners. And that gave them the confidence, that, okay, I feel comfortable with this. And some of the feedback we received around these assignments is one of the learners said, the thought of picking up a transition plan used to be a scary proposition. But having gone through this exercise, I can now read transition plans with confidence. So this is the kind of education that I think we need. And it's not only the certificates, there's a lot of good stuff out there by other organizations as well. There are some fabulous podcasts. We recently published a topical research piece called Modeling Climate Transition Risk, where we are recommending that investors use scenario-based approaches to predict asset losses, the difference between the 1.5-degree scenario and 2-degree scenario. So for anyone looking to upskill, there's a lot of useful stuff out there.
Sonia, I just want to add, I have done my investing in ESG certificate from CFA some time back, and I know a lot of them who have done it, and it was extremely beneficial. So I think kudos to you and the team who have built it, and I'm about to complete my climate one as well, and it is very deeply thought and a lot of good content which is available there. So just want to kind of acknowledge that.
Thanks, Ankur.
Fantastic. I also wanted to know more about the different cycles that we see globally, because investing typically, or not just sustainable, but investing has your own set of cycles that you go through, and so has sustainable investing globally. Now, how do you see, Hardik, that impacting trends, whether it's in the global setup, the world over, or specifically in India? How has these different cycles that have taken place in sustainable investing had an impact?
Sure. So I think if you think about like when this become mainstream, I would kind of point out at the Paris Climate Agreement, which was signed in December 2015, as one of the key triggers, and then the momentum kind of picked up towards 2017, 2018. That's when you saw a huge interest from asset owners to allocate to, I would say, quote unquote ESG funds. Now, ESG is not one single approach, one single strategy. There are multiple things you could do, but broadly, you saw a lot of flows being redirected towards funds that consider environmental, social, and governance criteria while making those investments. This kind of, I would say, great phase or a good phase of ESG lasted until, let's say, 2021, 2022, where in that period, not only that I would say genuine asset managers who are wanting to apply these principles in a systematic manner come into play, but there are also asset gatherers who kind of, I would say, for the lack of a better word, got greedy and tried to kind of rebrand some of their products as ESG or sustainable or green just to get in the assets under management. I think since 2021, 2022, you've seen regulations in different parts of the world kind of come in, and rightly so, in my opinion, to just avoid this so-called greenwashing or sustainability washing that the fund managers were doing in a way, sort of mis-selling, right? So you're not actually paying too much attention to certain things, but are telling something else in your marketing materials. So that has, I would say, caused a little bit of slowdown. I think we are more or less coming off that particular phase now as we end 2024, and I'm again seeing some momentum in terms of, I would say, more focused interest into investing in sustainable funds. What has changed from then to now? I think earlier people were more concerned about broad ESG factors. Do you look at an ESG score across ESG? Do you have are you a signatory to the principles for responsible investment, the PRI, and so on and so forth? Now, I think the interest is more focused. So, as an asset owner, someone might say, I'm mainly concerned about climate and carbon emissions in my portfolio, and that is what I want you to focus on. Else might say, I'm more concerned about human rights risk, and that's what I want you to focus on. So, that shift is clearly happening. It's not that people don't care about governance or people don't care about other topics, but the broad ESG kind of analysis and integration has pretty much become table stakes. A couple of quick comments on Indian landscape. I think it was in I would say 18 to 2021 is that's when most of the ESG funds in India were launched, or the ESG labeled funds in India were launched. I'd say about 8, 9 to 10 of them. There was that one phase of growth, and then since then pretty much there hasn't been any new launch. So the assets under management in those funds, let's say if you compare from 2020 until now, have grown about 4 times. So it's significant growth, but it's pretty much from a low base, right? So where things stand today, I personally feel there's a good mix of, I would say, external environmental factors that is going to drive the next level of growth. Two things. One, the SEBI requirements around corporate sustainability disclosures, the business responsibility reporting, or the BRSR, broadly that's called, that is now expanded to the top 1,000 listed companies in India. So you are getting, I would say, a decent level of disclosures from a wide variety of your investable universe. In addition to that, SEBI has also come out with certain guidelines on fund classification to prevent the greenwashing, the mis-selling that I talked about earlier that happened in the other global markets. So I think it's basically, from my perspective, time for Indian asset managers, to essentially level up and get to the next phase of more kind of nuanced investment products that you could offer to the market. And the key point here, and again going back to what Sonia was saying earlier, is creation of awareness, right? So if I take a parallel, I think about 6-7 years back, you saw this flurry of mutual fund Sahi Hai campaign going on, and that has worked wonders for the industry in terms of people systematically investing in mutual funds in India. I think if not at that scale, but something similar for creating more awareness about ESG and climate, if it happens in India, I think you'll clearly see a lot of interest, because this is not totally away from your usual way of investing. I think it's just more prudent way of investing, in my opinion.
Well put, Hardik. And Ankur, if you could add to what Hardik was just saying, because how exactly do you think is sustainable investing positioned in the Indian context at the moment, and do you think it has taken off as well as one had hoped or expected?
Sure. So I think let us kind of go back to the history and try to understand how SI has kind of evolved across different regions, and then we'll kind of touch upon specifically on India. But if we kind of look at other regions like EMEA and a lot of other APAC countries where SI assets are very dominant, it is primarily the institutional investors who have adopted certain principles and decided to kind of create that demand in ecosystem, which has indirectly kind of driven asset managers to create more complex and new solutions, kind of really building a lot of cash flows in the market. So in that context, as Hardik also highlighted, like there are a few funds which were launched between 2018 to 2021 in India, which has seen growth in AUM, but not not as scalable as compared to other markets. So if we kind of look at it from an Indian context, it's a heavy retail focused market. So it will have has its own set of challenges in terms of how we build the ecosystem. So it would not be fair to compare India versus other regions who have seen a very dominant growth on the SI side. However, if we look at the overall sustainable investing ecosystem, I would primarily bucket them across three key pillars. One is market policies, and I would say in this context, India have done really well. So SEBI has been really focused on for the future, where they have brought new regulations around fund classifications. We are one of the early adopters towards how third-party rating providers can provide their inputs. The BRSR norm, which Hardik has touched upon. So if we kind of look at a combination, the policies have really built that ecosystem in terms of how these things should be foreseen, and kind of really be preparing for the future before we start seeing trends of greenwashing. So that way, I think in terms of market policies, India has done really well prepping up for the future. Also, if we kind of see a lot of monetary and fiscal policies and also initiatives launched by the governments in terms of targets for setting up green ammonia hub, also a lot of subsidies which were incorporated towards electrification and renewable energy. This has really kind of set up the stage for both private and public market funds to kind of flow. So in terms of market policies, no doubt, I think we have done a really good job in terms of policies and the initiatives which were launched. Second important bit is industry adaptation, right? So how well are the corporates and financial institutions adopting ESG principles or sustainability principles and integrating and making it as a core part of their business strategy. So if we look at a lot of large corporates, at least in India, even though apart from BRSR, there is no really real demand in terms of how they kind of evolve sustainability into their core business. So they have really done well in terms of incorporating various initiatives, including shadow carbon pricing and a lot of forward-looking steps which companies corporates have taken in India to become net zero, or also enabling a lot of social issues which we see prevalent in the market. So again, in terms of adaptation, both from financial institutions, hiring new specialists around ESG, thinking broadly how we integrate ESG into our investment process, it has taken off really well in that sense. So I think the third piece is all about how do we build a market sizable and scalable. I think this is this place where we might be lacking compared to global peers, and one of the primary reason is this is primarily an institutional market. uh, it will build up for retail, and there is a lot of work which is happening in the industry in terms of bringing that awareness. It's just that these things takes time, specifically considering you are engaging with retail clients. However, I just want to bring the attention, what we have spoken about is public funds, but if we look at the private sector side, it has actually doing really well in terms of a lot of thematic investments around green transition and a lot of other sustainability related work. So it's not that the market size is not picking up, it's just that it is picking up more on the private side. And as we create more awareness for the retail investors, you will see more fund demand increasing in the future, and we'll move towards that direction. So in nutshell, I would say sustainable journey in India has been really well. I think it's more of a matter of time to build that ecosystem and awareness in the industry, which will effectively then trigger more domestic demands building up.
Hardik, if you could give us your perspective on how regulators could perhaps strike the right balance between encouraging sustainable finance growth while at the same time ensuring market stability and investor protection.
Yeah, so I think in the Indian context specifically, like Ankur was saying, a lot of the investors are retail investors, right? So I think it is important for the regulator to make sure that there is no mis-selling or any kind of investor loss because of mis-selling by asset managers. So I think regulators are in some form right in their place to be worried and making sure there are certain kind of guardrails in place. I think what is, to be honest, like what is the missing kind of piece here in the Indian market is essentially the institutional asset owners, right? So we don't have a lot of those, but there are some who need to kind of, like in other markets we've seen, public pension plan or the sovereign wealth fund kind of come in and say, we think ESG is important, or we think climate is an important topic, and we want all of our managers to kind of focus on that. I think that kind of signaling has to come in. And then on the retail side, we've already discussed that I think education or awareness creation is something that needs to be in place. I think the regulator is kind of doing their bit. I think this is very difficult. I mean, it's easy to criticize that, okay, there's too much regulation, but I think it's just more of making sure that there's the right kind of products in the market available for retail clients, and they are not essentially taken for a ride by investing in this product. So we totally understandable.
And Ankur, in terms of risk management, how can organizations perhaps develop a more robust framework to assess or manage climate related financial risks?
So I think there are two angles to it. One, obviously, when we look from a corporate perspective. So I think a common trend between the two would be transparency, right? So whenever you are trying to adopt something, you need to be able to explain your rationale and transparently disclose your thinking behind it. I believe that sustainability is a space where one size doesn't fit all. So every corporate, every financial institution might have a very unique and different approach to, key issues like climate and so on, and which is completely fine. That's where I think innovation kind of becomes a topic, and with different approaches, we will foresee different kind of product suits which would help us. But for me, transparency would be one of the key element to avoid any risk. If you are able to explain how you have approached it, what are some of the challenges and downsides of your approach, if any, and be able to disclose your methodology and criteria. So I think that is one key component through which we can mitigate any risk by being very transparent and disclosing this information. Second sided, I think, which I want to highlight is when we look at it more from an investor's context, it is important to understand. I think one of the core responsibility as investors we have is continue to generate long term sustainable returns for a client. And I want to emphasize on this long term and sustainable is two key words in this, right? And there is always a confusion when we kind of see a lot of activists jumping through criticizing ESG, that whenever these strategies are designed, it is designed to foresee long-term aspirations, and return and risk are the two key components whenever we are designing a strategy. So our our fiduciary responsibility is to generate returns for a client, right, and do it in a sustainable way. So that's one of the core message when we integrate ESG across our investment processes. We want to focus on the returns for the client. It's a myth that when people say that can ESG generate returns or sustainability generate returns, right? Because return is all risk, and return is always a core part of investing. So we need to segregate CSR and sustainable investing at two separate buckets, because generally there is a confusion and people tend to take philanthropic activities and mix it with sustainable investing. So CSR by virtue is a completely different way of approaching things versus sustainable investing. So as investors, we are investing for future for our clients, and hence mitigating that risk, having right exposure to across the sectors and including it in the portfolio and manage it efficiently is the way forward.
We all,
Sorry, if I can chime in a bit.
yeah,
I was laughing
sure.
when Ankur mentioned that is ESG kind of leaving returns on the table. The reason I was laughing is I was answering the exact same question 10 years back at a panel in Singapore, and we are almost at the brink of 2025, and those concerns still persist. Right? And I think it's valid concerns. I would not. I mean, as an investor, I'm worried that am I going to lose money by investing in a particular mutual fund or a particular investment product. But I think that the challenge lies in the definition of ESG. I think we've talked a lot about ESG, and I'm assuming most of the audience is kind of at least somewhat familiar with the topic. But kind of going to ESG 101, there are different ways you could implement an ESG strategy. There's no one single way. You could do a screening approach, meaning you screen in or screen out certain type of companies. You could do integration, which mostly what we are all of us are talking about, where if you talk about ESG integration, and this is the biggest or the most popular approach globally in terms of assets that are following this approach, the objective is not different from your investment objective. what essentially integration means is, are there any material, environmental, or social or governance issues that could impact the valuation of companies that we are investing in? And if yes, as a portfolio manager, as an investment analyst, I need to factor those into my projections, right? So it is very, very aligned to your goal of getting the best risk adjusted returns. And hence, you don't have to worry about, is this something different? Am I trying to save the planet? You are not. You're trying to, in a way, make your portfolio much more resilient. And if the theme plays out as we all hope so, then obviously these companies which are more sustainable and focusing on some of these climate solutions, for example, will grow and thrive much faster than the broad market as well.
The purpose of investing at the end of the day is to take back home some returns at the end of the day. As an investor, particularly retail investor, since you all were talking about it, Hardik, should one be worried about subpar returns or not so great returns by investing in ESG funds?
Yeah, I think I mean, part of it I did kind of talk about in my previous response, but I think the key here is the time horizon, right? If you're looking at
Yeah.
3 months, 6 months, or even a year, you might get returns all over the place because that's the nature of the markets as well. Uh, but if you're investing in the long term, I think in the long term, I wouldn't say, I'm not talking about 20 years, I'm even talking about 5 years or 5 to 10 years time frame. A lot of this risk will play out in a much bigger manner. I think in my first response at the start of the webinar, I was talking about how climate change and the related kind of ill effects of that are playing out in our day-to-day lives, right? So if you're talking about maybe, let's say, an insurance company, investing in an insurance company, because of erratic weather events that are kind of accelerated by climate change, these companies will basically be exposed to much more claims, right? And hence, if you don't factor that risk in, you will basically be buffering in a much higher profitability than that's what's going to play out. This is a very simple example, and there are examples in every industry where either ESG issues are a risk, or in some cases there are opportunity as well. And hence, I think if done in the right manner, in the long term, I don't see a risk of kind of losing on returns. In the short term, I think is anybody's guess, to be honest.
But Hardik, what about market infrastructure? What improvements right now are needed to sort of support the growth of sustainable finance in India, whether it's carbon markets, green ratings, so on?
Yeah, so I think what is what everybody agrees is some of these things are important, right? What people are not very clearly say having consistency on is, when will this play out, right? So nobody's saying, okay, if you're polluting a river, that's good. No, it's not. But are you getting penalized for doing that? Or if you're having excessive carbon emissions versus peers, that's a bad thing. But today in India, there is no carbon tax, right? So you could kind of keep doing that without much financial impact. But if since you talked about carbon tax, there's a carbon tax regime coming up in India around middle of next year. So once that comes in, it will be focused on certain, let's say, high emitting sectors, but there will be a monetary value to the carbon emissions attached. So if you are more efficient than peers, you will actually be able to benefit from that kind of efficiency. And if you're worse than peers, you'll have to pay the cost of it. So then once that kind of a regulation comes in, you're clearly kind of connecting the environmental impact to financial impact. And then it's kind of becomes much more easier to connect those two and then say, okay, why this makes sense. But I think in absence of enforcement, I wouldn't say there are lack of regulations. I think there are enough regulations even in India, but enforcement might vary to different levels. I think that is what is kind of somewhat, I would say, stopping, let's say, the deniers, saying, okay, this I don't think this is going to impact financially in the next 3 to 5 years, so why should I pay attention? I think that's where we are. But some of these things are becoming more and more idiosyncratic in nature. So if you are a company that is not managing certain risks well, you could just be simply lucky that something big hasn't happened, but it could happen tomorrow, right? So you can't really time the bad news in some form. So it's kind of, you're playing with your luck in some form if you're ignoring this. I'm not saying every single ESG factor really should change your investment decision. Some of them could be like priced in. I think eventually you're talking about valuations, right? Is it already priced in the valuation or not? But to be able to do this evaluation systematically, that is something that needs to be done without any doubt.
I think I
Ankur,
just want to add
yeah,
quickly one thing. So I think Hardik has really put up good thought in terms of how these things will impact the company. I just want to also highlight that there are a lot of macroeconomic factors which would also come into play when we talk about Indian corporates, specifically taking an example about cross-border carbon taxes which are getting imposed. So imagine a scenario where a lot of other regions who are moving towards sustainability imperative, and they keep imposing taxes on Indian companies where a lot of exports are happening. So imagine a scenario where if these carbon taxes are going to add up the cost for the companies, and this is going to indirectly impact the valuation and how they do business. So I think the key highlight is not just if the regulator has enacted domestically, doesn't mean that you can get away. There is a lot which is happening in the global regulatory framework, which would directly or indirectly be impacting and will push you to change the way you are operating your business at the moment.
okay. And Ankur, how do you think companies, investors can strike a balance between social responsibility and financial returns in their sustainable investment strategies? What do you think?
Yeah. So I think just going back to the same point I made earlier, right? First of all, we need to kind of segregate what investing means and what does a social responsibility mean. So as an investor, we continue to focus on generating returns for the client. So as Hardik kind of also emphasized upon it, whenever we approach any sustainability strategy, the core part of that approach is understanding client objectives, what is their risk budget, and how much return expectation they can have, right? So without a doubt, just the way any normal financial product is managed, the starting point for a sustainability strategy is exactly the same way. What we are trying to kind of bring a balance in, and if we kind of correlate to three P's which are very popular these days: profit, people, and planet, right? So obviously profit in terms of return is always a core part of the discussion, but as investors our core job is really to mitigate that risk for our clients in the strategies we are managing and generate alpha. uh, but when we are doing this, we always forget to factor in the external cost which these business are generating. It can be impacting the planet, which would have where these corporates will have a lot of dependencies upon. Taking an example, there are a lot of corporates which are struggling in various regions because of scarcity of water. Now, had they been very cognizant in terms of how they are consuming the natural resources, and they would have focused around building some efficiency around consumption of natural resources, this scenario might not have happened, right? So, planet is an important part, not in terms of measuring if, how much impact we are creating on the nature, but it's vice versa as well. You are dependent on a lot of ecosystem services, and in the end it is going to haunt the way you do business. It is going to impact your profit as well.
Hmm.
Second core part is people, where we have a lot of policies which are built in by corporates, and as investors, we need to understand there is a lot of intangible which comes from resources. So if you have highly skill set people, they are contributing towards the business growth as well. So for corporates, it is not just about generating profit, but you will be able to generate profit if you are able to rightly balance how your impact on the nature, your dependencies on it, the human resources which you are acting upon. So for me, the right balance is really to look at all the material risk which as a business you are exposed to. Try to understand not the short term repercussions, but if you are a long term investor, you need to focus on the long term, right? And you need to take right actions to mitigate, and not just wait with a hope and that pitch of luck that this event is not going to happen. So a lot of corporates are now planning to have some residue budget, or some cash which they keep for these critical events. Climate change, for example, is happening in real. There are a lot of damages which are happening because of these events. So as a corporate, you need to plan for it, and keeping profit obviously at the core, but you need to think of the dependencies and need to balance the planet and people expectations when you're running a business.
Ankur, if you could also, highlight what are the big or more recent global trends in sustainable investing and how are they relevant in the Indian context?
Sure. I think there are many, but I would maybe let's focus on two of them and go into a bit of detail. So one, I think we have touched upon it in some of our conversations previously. Energy transition continues to be one of the key theme, and I'm not saying it because I'm into the sustainability space. It is actually the market which is driving this. A lot of geopolitics risk which has built up. Primarily, Russia and Ukraine war has been one of the great example where the energy prices in the Europe have really shooten up, and a lot of countries have realized that they need to become independent in how they source energies, and also need to have multiple sources of energy rather than completely relying on fossil fuels.
Hmm.
I could understand the hesitation few years back where the cost of using renewable energies was much higher, but as we see higher adoption globally across the market, the unit of cost of operating on renewables are becoming much cheaper and competitive with fossil fuel. And we can see a clear trend in India. Like, I don't know if you have been following the news, but India has a commitment to become net zero by 2070, and by 2030, I think they have decided to split their energy sources to 50%, which means 50% of the energy coming from renewables and 50% on fossil fuels. So it's not about completely isolating yourself and saying I don't want to use fossil fuel as a source of energy, but be very pragmatic in
Hmm.
terms of what is accessible in terms of business cost, what small steps you can take to move forward. So uh, in that sense, if we see there is a lot of green wave around renewable energy coming up, a lot of big corporates and as well as private companies are investing heavily in it. So definitely, I would say it's one of the greatest opportunity which is available in this decade to explore for. And as I said, a lot of private capital has already flown into it. I think a lot of public money is going as well. So that's one of the key trend I would say is on the table. And early adopters would see a lot of benefits from that. Second is climate adaptation. So as the physical risk continue to impact various sectors including infrastructure, it continues to create a lot of noise and disturbance across supply chain and connectivity. India obviously has a lot of coastal exposure, and we tend to we get to see a lot of issues as flooding happens and these storms coming in. So climate adaptation is another key topic which is picking up globally, and it is pretty much relevant from an Indian context as well, where if we can leeway the right infrastructure, we would be able to at least reduce some of the damages we are currently seeing from these physical events. So these two topics are definitely at the core right now. There are two more which I would like to highlight by not getting into the detail. I know we are running on time here, but AI would continue to be the key topic for coming years as we talk not just from a risk perspective, but I would say from an opportunity perspective as well. Uh, as we continue to kind of see the impact of generative AI, both in positive and negative term, the adoption of right technologies, and I've seen this in live. I was actually on a ESG field trip last year, and I've seen a lot of utility companies building their dashboard and integrated AI capability where they were able to actually understand the energy efficiency they are providing on daily basis, and on live they can actually use geospatial technology to understand which grid has problems, which grid is not very efficient, and so on. So AI is going to definitely change the landscape, the way we operate in future. And lastly, decarbonization and low carbon solutions would continue to evolve. And you will see a lot of innovation happening in this space through green hydrogen in terms of some new sources of energy, and the way transportation sector is going to evolve in future.
Wonderful. Thank you so much, Sonia, Ankur, as well as Hardik, for sharing your insights with us and telling us, or rather giving us a glimpse of what is happening in the sustainable investing space, not just abroad, but even back home on the Indian turf as well. So, wonderful conversation. Thank you once again, all three of you.
Thank you.
Thank
So,
you,
as
and
the
thank you for
industry
organizing.
Thank you.